Hello and welcome to Market Domination. I'm Julie Hyman, Jared Blickry in for Josh Lipton today, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz getting you up to speed 1 hour before the closing bell rings on Wall Street.
Our pricing is held up very strong across the board. We saw average transaction prices essentially flat, and while incentives have ticked a little bit higher, we've actually seen pricing improve April month to date so far. So really a lot of momentum that's fueled by the great products that we're producing and the strong customer demand for them.
Double-digit revenue growth, double-digit operating profit growth, beat earnings expectations. It's an awesome story, and the company's really benefiting from some tailwinds in the industry. It's a good time right now for GE Aerospace, and it was a good time for GE to focus on just that business.
Investors are going to want to see how this emerging technology is going to fold into not just the tech sector, but other sectors as well. It's going to be something that's a longer-term theme, and investors are going to want to know how these companies are going to fold that in.
We've got 1 hour to go until the market close, so let's take a look at the major averages sponsored by Tasty Trade. We've got the rally continuing here today. The Dow right now up about 235 points, 0.2%. The S&P up better than 1% and setting up for its biggest two-day gain since February. The Nasdaq, though, is the leader today. It's up by 1.6%. So earnings are a part of the story today, but also a part of the story is what's going on in the bond market, because there we see a little bit of a relief on yields. Not a big move downward, but there was a record-setting in terms of size two-year auction today that drew a better than estimated demand. And so that demand pushing prices up across the yield curve and pushing yields down a little bit. That is mainly benefiting what we're seeing in big tech. That's something we've seen, right? Also, we know big tech sold off especially sharply last week, so it is coming back today. So the two best performing sectors, communication services as well as technology. Consumer discretionary also playing their materials, though, in the lagging position. And if you look at the Nasdaq 100, you see a lot of green here on this screen as a lot of these big cap stocks and tech stocks generally bounce back from some of the losses that we had last week. Nvidia up 3.3%, Alphabet, Microsoft, Apple, Amazon, Meta, all of them are trading higher today. And of course, we are awaiting a lot of earnings from these large cap tech companies as well to see where things are going to go from here, Jared.
That's right, Julie. And we're an hour away from Tesla's first quarter earnings report. Comes at a crucial time for the company, with shares trading near 52-week lows as investor sentiment and EV demand, it slides. And with more on this and what to expect, we're joined by Praz Subramanian. Thank you for joining us here. All right, 1 hour to go. We're hoping it's on time. Fingers crossed here. But what should we expect?
Yeah, so top line here, right? Adjusted EPS, 52 cents a share, and then top line revenue. Sorry. EPS, adjusted EPS, bottom line, 52 cents a share. Top line revenue of $22.31 billion. I got ahead of myself there.
Yes.
That would be the first revenue decline in 4 years for Tesla. Also looking at $1.5 billion in operating profit, a 40% slide from a year ago. So you mentioned that possibly demand issues, demand concerns there. Might see that in the revenue figures. All these cost cutting, all these different initiatives there. Might see that in the profitability coming down, cash flow kind of coming down. Concerns there for investors. We saw the the Q1 deliveries miss with the not only for deliveries down, but production high. And there's a big kind of swing there in terms of the buildup in inventory. Another concern of a possible demand issue as well if we're seeing that those inventories pile up. Last thing, product roadmap. Are we going to hear more about that Model 2 vehicle? Is it truly dead? Is it just on hiatus? Is it going to come back? Is it just something that Elon Musk no longer wants to do and focus more on robo-taxis, which is more of a concern for, are you willing to wait till how many X number of years for those vehicles to come out and also be profitable?
So just to put things in context, though, in terms of whether we're going to learn more on that, what do Tesla's earnings calls tend to be like? Does he tend to address that kind of stuff?
Typically, they'll say, we don't talk about future products in our earnings calls. But because of the fact that he did tweet out that the robotaxi is going to be supposedly seen or launched or revealed on August 8th, I think he perhaps will owe investors and obviously analysts some more detail on that. Potentially, what are we going to see? Is it going to be a drawing? Is it going to be an actual car? We'll see what he says. It could be.
It's a drawing.
It could be a design sketch.
It could
I'll
be.
root for that.
It could be. Now, in contrast to Tesla, which, as we know, has not set up well for the earnings in terms of how the stock is doing, General Motors actually came out with a pretty decent report today.
Yeah. I mean, look, boosting their guidance here, strong profit, strong, decent revenue here for Q1, coming off that Q4 where they were impacted by UAW strikes and things like that. So GM sort of on a roll here. Some analysts had expected they would boost their full year guidance, and they did. And so that's pretty good for them. They're seeing that prices sort of stayed the same year over year. Which is interesting because revenue went up and sales were kind of flat. So that's kind of, they're talking about how fleet sales are down, but enthusiasm at the retail level is still pretty high. And this is in the face of higher rates, right? The consumers are still wanting their cars. We saw a little bit of an inventory pileup. GM says that that's not a concern. They still see their buyers as wanting to kind of replenish their car supply and things like that. So looking good so far there for GM as of right now.
Thanks, Pras. Looking forward to the numbers from Tesla. Thanks so much for all of that. Well, stocks are climbing with investors preparing for a fresh wave of big tech earnings highlighted by Tesla later today. The EV maker will set the bar for more mega cap stocks this week, though some suspect the momentum might be fading. For more on earnings and the best ways to be positioned, let's welcome in Phil Blancato, Chief Market Strategist at Osaic and Chief Executive Officer at Ladenburg Asset Management. Thanks so much for being here. So we were just talking about Tesla, but more broadly, of course, we saw the slump in the so-called Magnificent Seven or Five or Two, or however you're counting them these days. Big cap tech got hit. Where do you think we go from here, and how are we set up going into some of these companies' earnings?
It's interesting. If you went kind of old school, you'd argue today was an offensive play for market versus a defensive play last week. But I would argue the other side of this. When things get rough, like I think the second quarter is going to be a pretty tough quarter for a lot of reasons. Slower earnings, even though so far they've been fine, but politics, geopolitics, all these things are going to make this quarter harder. Traditionally, it's a tough quarter. I think sometimes we forget the Mag 7 are very defensive. Microsoft in and of itself makes $3.5 billion on cash alone with $150 billion in cash. The same for Apple, the same for a few of the other Mag 7s, that they make so much on cash. Added with their revenues are exceptional. Think about the explosion in NVIDIA's revenue. It tells you that these companies not only are the leaders of the marketplace, but they're the ones who act the most defensive. And the market realized that today, and that's why you're getting a reflective bounce from it. It's really a normal trade at a time of volatility. Pivot to your best names.
Phil, could you dive into a little bit more detail on some of these headwinds that you're expecting in the second quarter here? As you know, we're early on here, but we are in the midst of the busiest earnings week of the calendar. So what should we be aware of as we head into this, and where do we put our assets as a result of these beliefs?
So I'm going to argue that most of your investors on this already own those big Mag 7 names. And while if you safe to say, and I would say if you have money there and you haven't taken any profits, especially a little bounce like this, I do advocate moving some of that money away in the traditionally more defensive sectors. Why? I want to see it earn a dividend. I think the energy sector is really underpriced. The financials have really come back and look quite strong. Have hung in here real well. So the other parts of the market that have better valuations are going to get you through the next 2 quarters. The next 2 quarters are difficult because we are seeing a gradual slowdown in the labor market. For example, you look at the number of open jobs versus the number of job people looking. That number is continuing to narrow. You look at things like flash PMI sales, why the 10-year sold off a little bit. There's some weaknesses again in manufacturing, even in services. You're starting to see this concern around earnings. Every company going to meet expectations. If they do, it's still only 3%. So when you look at the value of stocks, that price divided by how much they're earning, it's still too expensive. We're 3 to 4 points above historical averages. So you got to have a lot of believability when you're going into traditionally very difficult months in the market. April's usually the best month. This year was the worst, followed by the months to come. Remember, August and September are really challenging months. Mix in all the geopolitics we're dealing with, plus an election, plus a slowdown in earnings, which we expect going through this quarter into next. And suddenly the market's going to trade very sideways. How do you defend yourself? Earn a dividend, get paid to wait around, but don't sell out of the Mag 7s. You want balance right now. And that's where I would suggest your investors go. If you've only been in growth stocks and you've made a bunch of money, it's okay. Take a little profit here and pivot to where you get better valuations and a better dividend.
It's interesting, Bill, you haven't talked that much about rates and where rates are going. Is this sort of a rate agnostic view in terms of when we're going to get cuts, how many cuts we're going to get, et cetera?
So I'm going to camp that there's only one cut this year. If not, it's probably zero. But I'm going to be a bit provocative for you. What I want your folks to do is, I actually think a balanced portfolio is the winner this year. And the reason why I do expect a rally in bonds when we get this expectation of the Fed is just finally going to get around to it, whether it's one cut or no cuts, but at least talking about it. That fourth quarter of the year is going to be a gigantic quarter for the bond market like last year. I jokingly call this the Yogi Bear market. It's deja vu all over again. A good first couple of months, a very difficult summer, a rally into the end of the year, especially in the bond market, because remember, if yields cooling off a bit as inflation eventually cools off, it's not quite there yet. We still got a little bit of ways to go. You'll get a significant rally in the bond market. So I would tell your investors, don't be afraid to go buy bonds here. And I would tell you to put 25% on the short end of the curve, 50 in the belly of the curve in the middle, and 25% long. And as we go through the year, start to shift to the long end of the curve, go out 10 years or plus in bonds. Why? Because not only do you get tremendous price appreciation, but you still get a pretty wonderful yield. There's a great opportunity in the bond market besides being balanced in your equity portfolio.
Phil, we got time for one more. Just want to stick with the Fed here for a second. What if the inflation data starts ticking to the upside? And we've seen some of the 3 months, some of the 6 month, and even the yearly comps now inflect to the upside, including Supercore X housing. Just wondering, what are the odds here that we don't even discuss a rate cut potentially a month, 2 months from now, but we're thinking about rate raises because of that inflation data? Is that on your radar at all?
It is, but that's exactly, I want to describe it as 25, 50, 25, or even 50, 25, 25, meaning where you place your bet. You don't need to go too far and take risk yet. But let's not forget, if you're earning 4 to 5%, depending on where you make your bond bet, you're going to make up for any hurt you get in rising rates. Remember, as rates go down, your prices go up. But as rates go up, your prices go down. So my point is, even if rates go up a bit, because you're right, we don't get there, we got to go another quarter point higher, I don't think you're going to feel it really significantly. Look at this year. The Barclays Ag is only down about 2%, 2.5% on the year. And yet we've had a move from, call it 3.75 to 4%. Really since the end of the year and from December forward. So we've already felt a significant move higher in rates. It really hasn't had a big impact on prices. Why? Because you're getting that wonderful yield. So to your point, it could happen. We're not there yet. But eventually the Fed is going to get there. Why? Because they're overweighted the credit card debt, they're overweighted the auto loans, what's happening in the housing market, and most importantly, corporate earnings will suffer once you have this debt wall, this number of corporate bonds that are going to start to mature this year and into next year, mature at a higher rate. That'll put pressure on earnings. That puts pressure on the labor market. Eventually, the Fed's going to get their way. You're going to see consumers get tired of spending more. Corporations get tired of having to pay up more, and they're going to protect earnings. And how they do that is they cut expenses by laying people off. So eventually, the Fed will get their way. It's just taking longer than we expected. That's why I think you'll talk about it in November. Maybe get a first cut. If I'm right, then inflation slowly cools down here, and we go into next year. If I'm wrong, you're still going to be okay by having a longer bond duration and winning eventually on that price appreciation. Remember, the AG or the TOTL, the 20-year bond index, 20-year bond ETF, was up 20% in the last 2 months of the year. I really like that trade if you're willing to take a little risk on interest rates here.
Phil, lots of stuff to chew on. Really appreciate it. Thank you.
Thank you.
We're just getting started here on Market Domination. Coming up, shares of Roblox getting a boost today following an upgrade at JP Morgan. We will be checking on that stock as well as other trending tickers on the other side. Plus, the FTC has moved to block the luxury fashion tie-up between Tapestry and Capri Holdings. We'll be joined by a fashion veteran later in the hour to break down the deal and the latest surrounding the luxury industry. Plus, earnings season's in full swing. We'll get you all the numbers from the likes of Tesla, Visa, Mattel, and more. Stay tuned. More Market Domination coming right up.
IBM reportedly nearing a deal to acquire cloud software provider Hashi Corp. That's according to the Wall Street Journal. The takeover of Hashi Corp reportedly could come together in the coming days. And Julie, this is a software company that helps, I guess, companies build up their cloud infrastructure. I wasn't familiar with them. If we go to the Wi-Fi Interactive, I'll just chart it real quickly because this is a company which listed, it looks like they came to market as a public company at an unfortunate time. This is the very beginning of the 2022 bear market, so big slump there and just kind of finding their footing maybe as they consolidate at the lower end of this range. For IBM, here's a chart that goes back to the 1960s. That's a pretty long-term chart. Here's a 20-year chart, but you can see this is a very, very, very long-forming potential cup and handle, but it would probably take another 2 years for this to complete. IBM is just a very slow-moving stock. It's a legacy stock, but it's just always funny to me how these patterns, they hold whether it's intraday or on a chart back to the 1960s.
Yeah, I mean, it's a legacy stock. It's also a very acquisitive company, right?
Yes, it is now.
I mean, it is a huge company, right, of over $150 billion in market cap. So the Hashi Corp deal for what, around, before this story came out, the market cap was
like
just under $5 billion,
yes.
right? So, you know, it's not a huge deal in IBM terms, but it's made a lot of acquisitions to sort of build it up into the IBM that we see today. So we don't know if this one is actually happening, but the stock, at least of the Hashi Corp, is behaving as though it is. Yes.
Lifting off the lower bounds.
Yes. All right, let's talk about our call of the day here. JP Morgan upgrading Roblox to overweight from neutral, raising the price target to $48 from $41. Shares of the online gaming platform are indeed higher today. By the way, Roblox is going to be reporting its full earnings on May 9th. The stock is down about 20% year to date coming into this. And of course, that's part of the reason why the JP Morgan folks like Roblox. They think it has been underappreciated here. And they said right now you've got a compelling entry point for the company because it's growing bookings by 20%. It's exiting a heavy investment cycle, and it's ramping 2 new revenue streams in terms of advertising and commerce. There's been there's been a lot of concern about Roblox sort of turning over its fan base, right? That they're going elsewhere.
That's the debate where, that's also probably why they don't want to monetize too quickly because that turns off users. But there's some comments here from JP Morgan regarding that. There's a significant monetization opportunity for Roblox. We're expecting developers to embrace advertising given the revenue share opportunity, as well as 80% of hours that are currently not monetized. So it doesn't actually give the percentage that are not monetized, but just seems like a little bit. We expect this support sustain 20% plus bookings growth, which combined with Roblox coming out of a heavy investment cycle, so that's planning for the future, should result in free cash flow, FCF, compounding at 40% plus through 2027. 40% plus is going to compound really quickly. If all of this investment in their company works out as planned, you know, that's something to hope for the future. Let me just chart it real quickly. If we could go to the Wi-Fi Interactive, I have since their IPO, I was just charting another company, Hashi Corp, that 2022 bear market took a lot of the wind out of the sails in Roblox here, but you can see it's just been treading water for the last couple years.
Yes, it has, after it had its direct listing a few years ago.
Yes.
Well, the Federal Trade Commission is moving to block the luxury fashion tie-up between Tapestry and Capri Holdings. The FTC says the deal will give Tapestry a dominant share of what it calls the accessible luxury handbag market. Former LVMH chairman of North America, Pauline Brown, is joining us now to discuss that and more of what's going on in the industry. What do you make of this, of this objection to this particular deal, Pauline?
Well, I was surprised that it was blocked on that front. I was surprised, number one, because we've never really seen this, at least in my career, in fashion. Fashion is so broadly defined, and what they're calling aspirational luxury is sort of ill-defined. If you look at competitors like LVMH, where I worked, or Kering or Richemont, I mean, they're consolidators much more aggressively than these two companies. They're just not U.S. based. So I was surprised. I was surprised also, I'd say the closest comparable would be some of the roll-up we've seen in a department store like Macy's. And to me, that's a much more aggressive example. And the last reason I guess I was surprised is the argument that was made by Lina Khan was not one that was around protection of the consumer and the pricing, but more around employees. that this would really put a lock on their hiring power or their negotiating power to be part of the industry.
Pauline, I also find this especially interesting at a time when it feels like that this industry is sort of more wide open than it used to be. I mean, just speaking anecdotally, as someone on social media, as many of us are, you get bombarded by ads for just this category, this sort of, well, maybe I'm telling on myself by saying this, but you get a lot of ads for startups, for brands that have a bigger reach. Do you think that those kinds of brands do present more of a competitive threat to a Tapestry, Capri than they used to?
Look, I think most of these brands are right now just trying to survive. Fashion at the luxury end, in particular, is a very unforgiving business. There are not too many I can think of where 100% of your product line turns over every few months. And economies of scale do play in a way that can be very, very hard for these upstarts. I think the advantage that many of them that you're referencing may have is that they can get to the customer directly. They don't have to go through wholesale accounts, which can be prohibitively expensive. They don't have to open their own store the way they did in decades past. So there's more access to the market, but there's also a lot more noise in the market. And there's a lot more, I would say, demand from the customer base. Customers are very difficult when it comes to selling fashion. Even when they love a brand, they're quick to move on to the next thing.
Yes, and their tastes have changed considerably over the years, especially over the pandemic. Just wondering, could you tell us of any trends you've noticed and some of the companies perhaps that have been able to capitalize on these trends, and maybe just outline who's missing the boat and why, for instance?
Well, I focus mostly on the luxury side of the market. And I would say it had an unprecedented growth wave from 2008, really through the pandemic, above and beyond what anyone would have expected. And it is finally catching up. So if you may have noticed today, Kering came out, had a really, really weak quarter and actually was cautioning investors that its profits for the first half will be down 40 to 45%. So I would say with regards to that segment, we're seeing that the party's sort of coming to an end. Doesn't mean it's going to crash. There's still a market for luxury goods and luxury fashion. It just means that I think it's very saturated. And to answer your question about trends, I mean, one of the trends at the high end of the market that I think is catching up with it is price inflation. The cost of many bags by brands like Vuitton and Dior and Chanel are 50% up from 5 years ago. And that is not a cost of goods issue, I guarantee. It's just that there's been a lot of appetite for these brands, and the appetite's now cooling off.
Pauline, when you say the party is perhaps coming to an end in certain places, would you say that is, in particular in China, it's coming to an end, which is something that Kering called out? Or do you think that globally we're seeing a slowdown in some demand?
Well, it's most acute in China. And, this is really a business where China catches a cold and we're all sniffling. But U.S. is soft, too. U.S. is not, not showing nearly as much extreme in its tempered approach. But I would say here where I'm seeing a pullback is more resistant to the pricing. That even ultra-affluent consumers are starting to say, you know what, it's just not worth it. I think in China you have some bigger macro issues that, were inevitable. I mean, it could not have kept growing at the size that it is. And now the level of competitiveness that it is, it could not have kept growing as it has the last few years. But I think everyone deep down probably wanted it to continue for a few more years.
All right, we have to leave it there. Really appreciate you joining us today. Pauline Brown, thank you.
Good to see you.
And coming up, the FDA is approving Immunity Bio's new combination therapy to treat a type of bladder cancer, and the shares are soaring today. Company's executive chairman joins the show on the other side. Stay tuned, more market domination still to come.
The FDA is approving Immunity Bio's new combination therapy to treat a type of bladder cancer. This is the first product approval by a health authority for the company. And for more, we're bringing the executive chairman for Immunity Bio into the program, Dr. Patrick Soon-Shiong, and Yahoo Finance's Anjali Kamlani. Thank you so much for being here. So talk to me about this drug, about your expectations for it, and how soon you're going to be able to get it to patients.
Well, the excitement about us for this drug, I think it's the next generation immunotherapy. Our expectations is that, as you know about Keytruda and Nivo, the checkpoint inhibitors have made a major impact, but unfortunately the patients still fail after that. And this drug is the first drug, as far as I know, that activates the natural killer cell that talks to the T cell and generates complete remission that is completely durable at this point for 47 months and longer.
Patrick, Anjali here. Really good to talk to you again. I know that this has been quite a road for the company. You had to go back and forth with the FDA last year regarding some manufacturing issues. Talk to me about, now that you've got this approval in hand, what that really means for the company, sort of financially, and how you anticipate this is going to help the bottom line. What is the addressable market here?
Well, what's exciting, as you know, unfortunately, we're not manufacturing this product ourselves. We're using a contract manufacturer, but we solved that problem. And what's exciting is that this is a backbone, we believe, to not only BCG, but to checkpoint inhibitors. And since March 2017, we've initiated trials across multiple tumor types. The concept here is rather completely different in the sense that the natural killer cell in your body addresses all cancer types, regardless of the anatomy. So we've now in phase 2s and completed some trials in lung cancer, and we phase 2s in triple-negative breast cancer, Merkel cell cancer, pancreatic cancer, head and neck cancer. And you begin to sort of see, by us getting this first approval for bladder cancer, which itself is a huge unmet need, the opportunity to use this as a fundamental platform across all tumor types in which we are in clinical trials. And we'll be holding a conference call on Friday to announce the next indication for which we really have a meeting with the agency.
Patrick, certainly it sounds exciting from a medical perspective. Again, though, I want to sort of reiterate what Anjali asked, which is financially, what this means for the company. I think investors would, certainly they're bidding up the shares of the company today, but I think we're trying to get our arms around what this means. When you got the first rejection for this drug, there were questions being raised about Immunity Bio's cash position. So can you confirm that you're now on solid position on that front and where you're going from here?
Well, what we did when that happened was I personally invested, together with our other companies, over $400 million at that point in time, so that we would have a firm standing. And then Oberling made a non-dilutive investment. And again, we'll announce on Friday, yet another $100 million is coming in a non-dilutive way. So no, the balance sheet is very strong. And what's important is that we believe we will have commercial launch available drug by May. So this will put us not only on a strong financial footing, but as I said, by us being the next generation platform, Keytruda has $30 billion in revenue, but the patent life of that's going off by 2028. This is now putting us in the position to be the company that's going to take all checkpoints and put it into this next generation. So this first approval is fundamental because all the issues regarding manufacturing, they've been settled. The clinical data is very strong, and that's why last year we made a commitment of 400 million, Oberling put in 300 million, and so the company is completely stable in terms of cash capabilities.
Copy that. I would like to switch gears and ask you about one of your other hats that you wear, and that's as owner of the Los Angeles Times. The paper has had a number of layoffs that were announced earlier this year. How do you make money in the journalism business right now, and in particular in the newspaper business?
Well, I think we just have to be honest that the platforms of usurping the hard work of reporters, taking it for free and utilizing it and actually usurping all the ad money. And if you look at Google, their ad revenue of 130 billion in minutes or half a day, they make more ad revenue than the entire LA Times. So that's not a sustainable system if we really want to protect democracy, if we really want freedom of the press, if we really want organizations with integrity to talk truth to power. So you're right, it is a challenge. Australia and Canada has sorted out that challenge where they've asked and forced these platforms to pay a fair use. It's not that we want the platforms to use it, but really to fairly compensate the hardworking journalists. So that's how we need to sort of sort this through. But I'm committed to actually support the LA Times, and we'll be coming out. In fact, this week I'll be announcing a whole new publishing organization within the LA Times called LA Times Publishing, with a thing called LA Times Stream. Our food festival, book festival, beg your pardon, over the last weekend, 150,000 people attended in Los Angeles, and we went live. It was one of the experiments for us to test, and there was a live feed throughout that book festival. So we have to actually find innovative ways to become a media platform, not just a newspaper.
Well, I hope we can continue this conversation about all of this soon. Thank you so much, Dr. Patrick Soon-Shiong and our Anjali Kamlani. Thank you both.
You're welcome. Thanks for having me.
Thank you.
And checking in on the shares of GE Aerospace, the company reported its first quarterly results since becoming an independent company following the spinoff from General Electric. Shares are rising after the aerospace developer raised its 2024 forecast. And Julie, I was just looking at this stock on the Wi-Fi Interactive. I think it was interesting here. Let's see if I can find this. GE has had quite the transformation, and it's recently come up on a number of my scans here just because of the strength. Now, this is a max chart. What you see here, and this is another chart that goes back to the 1960s, but what we have here is a series of lower highs and lower lows, but the trend just reversed, and this is a multi-decade trend. So,
well, but does it still apply if it's a different company now?
Well, you know, this goes back to...
I don't know enough about charting.
Okay, that's a good philosophical question, because sometimes companies do M&A and they just inherit another company's price history. People trade off of charts, so they're somewhat self-fulfilling, but a valid point. You know, Jack Welch's GE was far cry from what we're seeing today. So, but on that front, though, I would just say that the run up here that's finally changed the trend has just been a big momentum surge, and so it probably has a ways to go. Although I'd expect some backing and filling.
Well, I mean, it sounds like that most analysts said that basically that GE Aerospace is off to a better start for this year than had been anticipated. The company said it's going to generate more than $5 billion worth of free cash flow this year. Remember,
yes,
free cash flow is that metric at GE that has always been an important one, and I guess is still important now that it's GE
negative for years.
Aerospace. Yes. Exactly. Also, just looking ahead, GE Vernova, which is the renewable energy spinoff from GE, is going to report its numbers on April 25th.
Yeah, and I just had that up on the Wi-Fi Interactive real quick. Ticker GEV is now positive 3.5% in the green after falling in the red after its debut there, Julie.
Yes, let's talk about one more stock that we are watching. That is Kimberly-Clark. Those shares rising after a beat on the top and bottom line for the first quarter. It also posted upbeat guidance for the full year here. And basically, analysts pointing to product volume trends that are better than had been anticipated. Remember, Kimberly-Clark makes products for your house.
Yeah, staples.
Staples. There you go. It's a consumer staples company. That's what the word I was looking for.
Yeah. Well, what I found interesting here, a couple of notes here have picked up on hyperinflation talk, and they actually have exposure because they supply products in emerging markets and developing markets. And here's Bernstein saying that the big beat on organic sales growth was supported by the hyperinflation in emerging markets. That's a change from it's been a detractor in the past, but I guess it can go both ways. However, history tells us that these periods of gross margin strength on the back of commodity cost cycles tend to be short-lived. And we see no obvious reason to believe that it's different this time. So a little bit of doubt there.
Interesting.
Yeah.
Well, but it's interesting that it is being backed up by volumes at the same time that they're benefiting from price, because that was the thing that was sort of missing for a lot of these companies over the past couple of years. As prices were going up, that's where all the profit was coming from and the sales were coming from. But volumes were kind of lagging. But it seems to be now Kimberly-Clark's volumes are picking up.
At least in these developing markets.
Yes.
All right, rate cut expectations just aren't what they used to be. After 3 straight months of unexpectedly hot inflation readings, several banks have scaled back their forecast for interest rate cuts. And recent commentary from Fed officials has supported the idea that policy adjustments, they could become later in the year, if at all. Now, economists at Citigroup are holding their call for rate cuts to come as early as June or July. Joining us now to discuss, Citi economist Veronica Clark. And Veronica, thank you for joining us here today. You've probably been asked this question many times, but we're here to discuss it again. You're standing by your call. Just explain it for us, please.
Yeah, we have been asked that question many times, of course. So I think we maybe are some of the last people expecting that the Fed will be cutting. We have a base case for June still. It very well could be July. But I think the fundamental difference for us is that we really do see this Fed as having a more dovish reaction function. It's not that we see some magical slowing in the inflation data. If anything, we think inflation is pretty sticky. But we think this is a Fed that is looking at some of this labor market data, even survey data like we had this morning, the PMI services employment number, and really getting worried that we might be entering a weaker labor market, and really wants to prevent that.
So at the same time, what we seem to have heard from Jay Powell most recently is that the Fed was sort of willing to wait, or is that not how you took his commentary?
No, I mean, I think that most Fed officials are certainly paying lip service to this idea that maybe we don't have enough confidence yet. Certainly the March data, just as strong as we had in February, isn't giving them further confidence. And if that is the trend, if we did have consistently stronger inflation data, then you would have to wait longer. But I think the bar for what the Fed will consider more easing in inflation is relatively low. And it was actually a bit interesting to hear that Fed officials expect March core PCE inflation on Friday to be at 2.8% year on year. That's the same as it was in February, but that's actually higher than what we're forecasting. That's higher than a lot of other forecasts, and they might be delivered a downside surprise on Friday. So that alone might be able to give them a bit more confidence that year on year inflation is coming down, inflation is slowing a bit more.
That's interesting, and we'll keep an eye out for that on Friday. Just thinking about the two sides of the Fed coin, we talked about inflation. You also talked about the labor market and a couple of cracks that you might be seeing there. Can you go into some detail and tell us what we should be aware of and maybe alert for in the labor market if there are, in fact, some of these cracks appearing?
Yeah, absolutely. I mean, it is still true that, of course, headline job growth payrolls are running very strong. We really don't see the signs of big layoffs yet. Initial jobless claims, which we get every Thursday, are still very low. But we're definitely seeing indications that businesses are pulling back on hiring. We've seen that in survey data. We've seen that in the hiring rate in the JOLT survey. We'll get that next week. And so it is true that hiring has really pulled back. And markets today are reacting to a weaker services PMI measure for employment. And so all these signs that hiring is pulling back that could result in some weaker headline job growth in a not too distant future. In Q2 you really are expecting to hire a bunch of people, and seasonal adjustment. We know there's been issues with seasonal adjustment. We might be in for a weaker payroll print at some upcoming month.
And what about the PCE report on Friday? What are you kind of expecting there?
Yeah, I mean, we have most of the components of PCE inflation from CPI and PPI. We're expecting a 0.3 month on month. It's a 0.26 unrounded. That's the same kind of monthly increase that we saw in February. But it really is that year on year reading, I think, that's most important. The Fed is expecting that year on year inflation for core PCE is flat at 2.8%. We're expecting it comes down to 2.7. That's where the consensus is also. If that's true, then maybe for Fed officials, that looks like a bit cooler inflation than they were expecting.
Veronica, good to see you. Thanks so much.
Thank you.
First quarter earnings season is in full swing with plenty of opportunities for investors. We'll discuss how to play the latest on market moves next on Market Domination. With earnings season in full swing, we're taking a look at the sectors and names that provide opportunities for investors in the Yahoo Finance Playbook. With more, we're joined by Nicole Webb, Wealth Enhancement Group Senior Vice President and Financial Advisor, alongside Michael Green, Simplify Asset Management Chief Strategist. Thank you both for being here. Appreciate it. Nicole, let's start with you, because it's been an interesting earnings season thus far. Obviously, stocks fell last week, but we have also not necessarily been seeing companies that be rewarded by the same magnitude that they have been in recent quarters. And even some companies that beat are getting punished. So what do you make of it?
Yeah. I think it's interesting. All of last week, we kind of had this thesis among ourselves that, the market was kind of looking for a new bottom, this place where we could level set and have upside from here. And I would say in some of the action today, it looks like we might have found that footing. And when we think about kind of Netflix is my favorite story of last week, just the punishment for forward guidance and some of what they're going to claw back in terms of what they give us, starting next year. To us, it's just all this playing out of where does the earnings growth for the rest of the year come from? And we had anticipated a deceleration from those mega tech names in the back half of this year. And so kind of below the surface, we see this churning, the broadening that everybody's talking about, and then some of that relative outperformance from places like the equal weight S&P.
All right, Michael, just your overview. How has earnings proceeded so far? Where do you expect it to go?
Well, I think the biggest surprises that have come out of earnings in general have been things like General Motors' announcement today that was accompanied by an astonishing buyback where they shrank the quantity of shares by around 17%. This is in contrast, that level of buyback is unprecedented for many of these companies for that to be happening in open markets. And it's just highlighting that the exceptionally cheap areas of the market, as long as there's a little bit of support that's coming in through the interest rate space, that really looks like that could be an area of focus. Now, of course, if the mega cap names continue to disappoint, and I find it somewhat ironic that, in a time period in which we heard announcements this morning that Apple was having its worst quarter in China since 2020, and we've seen some similar data that comes in to support similar dynamics, that we're very focused on the idea of where the earnings for the market is coming from. Clearly, the earnings from the market is coming from cheap stocks that have been buying back their shares. And if we can get some of a backdrop in terms of a reduction in interest rates, of backing off of the fears of inflation or the potential for the Fed to hike, there are areas of this market that are outright cheap.
Nicole, it's interesting when you're talking about, the valuation conversation, if you will, because you mentioned Netflix, for example, which is not one that folks would think of as a cheap stock per se. So how are you sort of weighting valuation right now?
Yeah, I think this all comes down to what side of strategy you're on. And really don't mean that as a cop-out. I think there's a place for being a trader and there's a place for being an investor. And so one of the mandates that we look at most specifically is, how are we tracking to the S&P in terms of, are we owning best-in-class management, best-in-class business across sector? And so this just is a unique opportunity, I would say, and maybe unique is a bigger word, but it's just one of those periods of time where you look at some of these mega cap companies and they've almost been like your piggy bank. And so now you're seeing kind of this shaving off, this redistribution, broadening of the market. You can say this in so many ways, but I do think if you're looking at, your own portfolio and you say, I'm underweight in certain sectors, then yes, Netflix is cheaper to buy today than it was. Similarly, Meta would be of the same vein. And so it's just, if you missed it in semis and you were underweight in the last run of NVIDIA, and you were fortunate enough to take some of that opportunity over the last couple of days to shore up your holdings, that's more where we're operating from.
Michael, I want to jump back. You mentioned some cheap sectors before, and you were also talking about interest rates. Could you go specifically what you're thinking there? How does your view of the interest rate structure, where you see it now, where you see it going, what does that cause you to think might be an opportunity here?
Well, the areas that we're seeing strength today, areas like automotive, for example, when you talk about cheapness,
Yes.
I understand that these are cyclicals. I understand that we have come through a cycle at this point that many people were concerned about the idea that we could go into a recession. But when you see a company like General Motors trading at 5 times earnings, in contrast to some of the larger cap names, obviously trading at much, much higher multiples, it sets the stage for them to do the exact same thing that they just did, which is to buy back an extraordinary amount of shares. We've seen this in coal companies. We're seeing this now in the old industrials. And despite all the headlines about, the chaos caused by a new UAW contract at high levels of compensation increase, it really is not slowing these companies down. What is slowing these companies down is the level of interest rates and the inability of consumers to finance the products. And so if there are solutions to that in the form of lower interest rates or even just relief and a time period of adjustment in which people can get used to much higher interest rates, then these companies could be well positioned. That's really going to be the key question. Do we get any interest rate relief that gives consumers a little bit of extra spending power for these companies to continue to buy back the extraordinary shares that they've been buying back?
And Nicole, it sounds to me like, well, what is your position on interest rates and where they're going and how much that's factoring into your investment decisions?
Yeah, and so I think Michael has made just some great points during this conversation. And to piggyback on something he was just saying, about the rate of financing, a name that we added to one of our strategies fairly recently would be John Deere. So of that same vein, they also have done some interesting work adding Starlink. We've seen a lot of agriculture go to South America where Starlink is going to be, bring internet to combines that you're not going to get from 5G networks because they don't exist there. And so, I do think that there's room for some of these companies if and when we do get that first rate cut. To us, the market as a whole did a really great job of moving from 6 cuts priced in to 3 cuts priced in with barely a hiccup. There's a little bit of this now, churning towards, okay, what if we get 0? To us, it's still a little bit early to say that cuts are off the table for this year. There has been no doubt in our minds that wealthy individuals, right? So going back to this bifurcated market, the bifurcated consumer, we're actually being rewarded by interest rates being as high as they are. They weren't using debt to finance second, third homes, flying Delta One. I mean, there's just this population of people, this concentration of wealth that's keeping the economy very stimulated and has not been slowed down by higher rates. And so we do believe that the Fed wants to make that first rate cut. And at the same time, the data over the last 3 months and some of the data that's come to light just in the last couple of days, continues to cause concern for the slowdown isn't really happening the way that it had been anticipated. And yet I still do think there's a lot of sensitivity to who is that consumer, because we have to make sure that we don't crush the bottom, in support and continued support of the top.
Yeah, we got to go here, but really appreciate you both stopping by, Nicole and Michael. And coming up, it's a closing bell on Wall Street, and that means it's almost time for Tesla's latest quarterly earnings. We're going to break down those numbers on the other side and get you caught up on everything you need to know from today's action. Stay tuned for Market Domination Overtime.
There's the closing bell on Wall Street, and now it's market domination overtime. Let's get you up to speed on the action from today's session as we look at what's going on. Jared, what do we got? You got the map up.
Yeah, I'll tell you what, we got some pretty solid gains here. Russell 2000 leading the way, 1.61%, just a hair above the Nasdaq, and then S&P 500 up 1.2%, and the Dow, the laggard here, but still up 0.7%. Just want to highlight the 10-year yield coming down a little bit, but it's really just stalled out over the last few days. In the bond market not pressuring equities markets, guess what? We've got a bit of a rally on our hands, and here's the sector breakdown. Only materials in the red today, down about 0.8%, but communication services and tech were by far and away the winners. Also industrials, healthcare, consumer discretionary, all of those outperforming, all of those up more than 1%. Just a quick look at the Nasdaq 100 so we can get a sense of the mega cap action here. Check out NVIDIA up 3.65%. Some other chip stocks in the green here and not a whole lot of red. Julie.
No, not a whole lot of red when it comes to large cap tech, and that market check sponsored by Tasty Trade. Well, a strong batch of earnings this morning, driving gains on Wall Street for a second straight day. For a look at the takeaways of our trading day, our own Miles Udlin and Josh Schaefer are here as we await Tesla earnings, guys. Miles, let's start with you.
Well, I think, when you have an earnings week like this, what's the zag? And I think the proper zag is that the most important week of earnings is actually when NVIDIA reports in a month. But
That's what you wrote in the morning brief today.
I wrote in the morning brief, but so it's my only take that I have. It's the only thing I've had time to think about in the last 36 hours. But no, I think when you look at the way that the market acted today, where you had kind of just a smattering of news, you had plenty of stocks. I mean, look at JetBlue down almost 20% today. Plenty of bad news out there. Spotify comes out with marginally positive news. That stock's up, 12, 14%. It's a little bit overwhelming, a lot bit overwhelming, I think, for where's the macro take in this amount of earnings. And that only intensifies starting tonight in a few minutes with Tesla. And then certainly when we get into Wednesday and Thursday of this week. And I think ultimately, Microsoft and Meta, that's probably the bid if there's going to be this is the macro take. But I think the volume of earnings makes it challenging in these moments to know for sure what the reaction is. As Jared mentioned, rates go down, stocks go up. So I think that trade feels to me at least like that's still the predominant story in markets.
And that stuck out to me, Miles, just the move we saw in the 10-year. Jared highlighted it was sort of a minor move and not necessarily big, but what stuck out to me today from that perspective was just the timing that we got it. It came right at 9:45 was when we saw the 10-year move down. 9:45 is when the S&P PMIs came out. The PMIs came out soft for the first time in a couple months. Now we know we also measure PMIs from the ISM, and that's usually actually followed more closely. But I did find that move sort of interesting that it came right as we sort of saw a little bit of weakness in some economic data, and that has not necessarily been the trend for the last couple months.
I think maybe the flip side of that is, the market, so stocks are up 2 days this week, great, okay, everything's good again. I'm not sure the market's in a great place when preliminary S&P PMIs are moving the market around. That's usually not the kind of data that you want to see catalyzing moves in the market if we're on, let's call it firmer footing, which it feels right now like investors are looking for some kind of ground to stand on that's a little bit more solid than the way we entered trading in April.
So Miles, you kind of brought up that you feel like the NVIDIA earnings week that we're going to get at the end of May, right, is sort of the most important week that we're going to see. Yeah. And one thing that I thought of off of that was it kind of depends on what part of the rally you're talking about, right? So to me, sort of the counter to that take that I thought of was you highlight we're getting a smattering of things and it's hard to kind of take away, maybe have a broad takeaway from this week or next week. Yep. But isn't that sort of what the market rally and the broadening we were pitched over the last couple months, isn't that where you want to see the earnings and see what's going on? And yes, NVIDIA matters, but when you look at sort of what drove the market, at least the rally we saw in February and March, it was kind of the other sectors. And so in some ways, if we want the broadening rally to continue in 24, you'd care a little bit more about some of the other earnings.
For sure. You want to see that. But the story coming out of the first quarter into April was that rally was not working anymore, right? You still have this rate sensitivity. And I think, the NVIDIA story, the importance of those earnings, and really the importance of the AI trade overall in the market essentially just shows that we remain in a narrative-driven market where, yes, earnings are getting better, but most of those earnings still come from not just Magnificent Seven, NVIDIA specifically. Like they are literally the most important driver of earnings by far on a single company basis. And so if the broadening thesis is also one driven by earnings, well, the earnings for the other 493 are going to be down, right? And they're going to be up if you include NVIDIA. So you kind of, it's like this very weird sort of challenge, I think, for strategists and for investors to square.
So let's get to one other company that's reporting earnings right now. Thank you guys for talking while we could look at the earnings, by the way. So Tesla coming out and missing pretty broadly here, both on the top and bottom line. First quarter adjusted earnings per share from Tesla, 45 cents. That is versus the 52 cents that were estimated. The first quarter revenue at $21.3 billion, the estimate for $22.3 billion. However, the company said it is going to accelerate the launch of more affordable models. So this is the news that the market had been waiting for. Remember, Reuters recently reported that the company was going to be pushing back the release, or perhaps even abandoning entirely the release of its more mass market, its cheaper vehicle. Elon Musk had, sort of tried to push back against that, but without a lot of specificity, and so did not convince the market, and instead said, oh, in fact, we're going to give more details on our robotaxi project in August. And so the market took that to mean the cheaper car isn't coming. I have to look at the actual letter and what exactly he says here. But yes, please, Miles. Miles has a letter.
All right, here you go. We have updated our future vehicle lineup to accelerate the launch of new models ahead of our previously communicated start production in the second half of 2025. So to your point, Julie, not only...
So it's going to be sooner?
Not only is Elon Musk, doubling down on the idea that reporting a couple weeks ago was not accurate with respect to the Model 2 or whatever that, new product, whatever you want to call it, but that they are going to accelerate that timeline. They go through these new vehicles, including more affordable models, utilize aspects of next-gen platforms, as well as aspects of our current platform, et cetera, et cetera. Last sentence of this section, our purpose-built robotaxi product will continue to pursue a revolutionary, quote, unboxed manufacturing strategy. So I almost see this as not only are we reversing back to, no, don't worry, this is about the lower cost vehicles, but also maybe softening some of the messaging that it's really the robotaxi event apparently happening in August, that will be the next catalyst for the stock. And if we are to take what some analysts had said last week, that the notion Tesla was paring back its aspirations for lower cost models as a thesis changer for the company, maybe with the stock up 5-6% in after hours, that puts the original thesis, as it were, back in play, a more comfortable place for investors. But so stock's down, 50% in the last several months, up 5% today. So, call hasn't happened. We'll see.
Yeah, so this is just the disruption trade. It's a levered bet on the future revenue streams from IP that, a new business model that really hasn't been seen yet. I don't know if you have any comments on that, but that's the way I see it.
Well, to me, that's kind of been the Tesla model for as far as what makes the stock work, right? Is sort of talking about things that are going to come in the future at some point
and
make
times too.
and make our business better, but maybe aren't necessarily happening tomorrow, and we don't have full clarity. Again, we haven't had the call yet. I'm sure analysts are going to ask for more clarity on exactly when the vehicles are going to be launched, sort of expectations, and be able to model around it. But it reminds me a little bit of when we started talking about the Cybertruck and people get excited, and then it's when does this actually impact the bottom line of the company? TBD.
Well, when has Musk ever said something was going to happen at a certain time and it actually happened at that time? I actually don't know the answer to this.
I don't think investors care, right?
Maybe not. Well, they haven't cared until recently, perhaps, right? I mean, his track record is not fantastic of meeting deadlines. So I wonder if it just is enough that that he says it's going to happen and it doesn't really matter when, to your point, Miles, that investors don't care. Is it? I don't know.
Well, it's the right time to do it, right? When you talk about, Julie, just the numbers that you highlighted off the top, not necessarily impressing anyone. Maybe it's the right time to just sort of steer the conversation in a different direction.
Or maybe the right time to do it would have been when Reuters came out with that report and actually come out and make a concrete statement.
Yeah, and something else I'd note in here, kind of right at the top of their letter, they talk about doubling down. We are investing in future growth, including AI infrastructure. So they're defending their CapEx spending here, which was $2.8 billion in the first quarter. Also talking about the recent job cuts, which hit just within the last couple of weeks. Company writing, we recently undertook cost-cutting exercise to increase operational efficiency. And in this environment, speaking of why 2024 resembles 2023, companies still get a lot of credit for coming out and saying that we're, being more efficient, or we are looking at additional efficiencies. I mean, we'll get, again, I think Alphabet's probably the one you're looking at later this week along those lines. And obviously, stock's been volatile here, but now back up almost 7%.
But he does say the update, talking about the new vehicles, may result in achieving less cost reduction than previously expected. So they're still committed to cost reduction, but it might not be as much as they thought
so I feel
it would
like,
be before. Trying to thread that needle.
I was going to say, I feel like of all the things we've pulled out so far from the letter, it's been both ways.
Yes.
It's been both.
Yes.
We're doing this and then doing less of that, but we're spending a lot of money, we're saving money, but not as much money as you thought. And I think that this explains everything about the Tesla story at this point in time, which is that
it's everything to everybody.
Well, it has always been everything to everybody, but it feels like, unlike a lot of stocks, when they go down 50%, everyone agrees, like, this thing is broken, it doesn't work. With Tesla, it really only gets murkier as it goes further down, because the way the company's history has played out, the way the stock has acted over time, to where we started this, it has never been true that what the company says or doesn't say is, necessarily something that, animates the truest of true believers.
Yes, it's true.
So we'll never sit here and be like, I'm sure I know what the Tesla story is. But
Thanks,
the stock's
guys.
up 6%,
I know,
so that's the answer.
Well, guess what? We're gonna for now it's up 6%. It could change. We're gonna talk more about it. Guys, thank you very much. Appreciate it. Joining us now with more on Tesla's quarter is Craig Irwin, Roth MKM Senior Research Analyst. Forget about the quarter for a minute, Craig. Obviously, we want to talk about what they're saying about these new vehicles. After that Reuters report, did Elon sort of scramble and say, well, did they abandon the Model 2 project and then they resurrected it after that came out? What happened?
So, I've been talking about the mini car since 2019, the biggest strategic bungle at Tesla the entire time I've known the company, just like more than 15 years, was when they decided to punt on the launch of the mini car. Right. So what happens when you go into production is you do a bake-off. You do a bake-off between different sites to figure out which sites can give you the best ramp trajectory, have the best economics, be well positioned for the associated markets. And to me, it sounded like Reuters got hold of a group that lost a bake-off. Right. So there's a bunch of people in an echo chamber that's relatively small saying the same thing. They're not going to cancel the mini car. They're committed to the mini car. That the engineering has been done for 3-4 years now. The question is whether or not they're going to use the super modular approach, which could save them a lot of money. They think maybe as much as 30-40% reduction in manufacturing costs. I doubt it, but they need to just get them rolling and adopt technology over time. That's what they're going to do. They're doing the right thing. They're better late than never. It's the right thing for the company.
What do you think we can expect from the call today?
Oh man, so they're going to give it a shot to get us excited about robotics and AI on the call, right? Elon's got some explaining to do. FSD, the price was only ever supposed to go up, and we got 12,000 to 8,000 this last week, and I guess subscriptions are no longer 200 a month or 100 a month. They're really pushing hard on FSD. Personally, I'm a bear, but there are people out there that like it. We need to see attach rates go up. And for there to be some elasticity of demand here, I'm kind of skeptical, right? Everybody knows that, but they're gonna do work hard to sell that. Robotics, I don't see how you get this front center in the Tesla story. They're trying, but it's all about cars. It's about the great technology and the market penetration. The most important thing is a discussion around Thailand. I think Thailand is kind of an alternative to India or to 3 million units in Shanghai, which I think was nixed. So if you can get a China-like supply chain where you get really low costs and great manufacturing volumes, Thailand could be a big winner for the company. They may make an effort to sell us on that. Cybertruck, a lot of complaints out there. They're probably going to address them head on, and they're probably going to sell us on this robo-taxi, which may or may not need to be called a cyber taxi.
And also, let's talk about the first quarter just for a second here, because they did miss. They missed on earnings. They missed on revenue. I'm now seeing at least Bloomberg's calculation of automotive gross margin ex regulatory credits at 16.4%, which is another narrowing of that automotive gross margin. Does it matter if they're saying the mini car is coming?
Well, let's talk about the positive point in there, right? 16.4% is what we calculated it at. That actually beat the consensus number I have of 15.8. It actually beat it. And I've seen other consensuses that different groups put around that were lower than that. So you've got a 60 basis point beat with all these issues around price cuts and challenges with manufacturing and an outage in Germany. This is a big deal. 60 basis point beat on gross margins is a very good thing. They absolutely missed this quarter. I mean, 8.5% year-over-year drop in units. They need to start growing again. The mini car is what can allow them that path to grow again. And they need to get there as fast as they can.
How fast can they get there? I mean, so they're out today. They're talking about bringing up the release date. What kind of, this is something, I don't know if you heard our conversation before. What kind of credibility does Elon Musk have when it comes to deadlines? His track record is not fantastic.
Oh man, you pick a vehicle. They've all been late, and it's usually not 3 months. It's 6 months to a year to 2 years. I mean, robo-taxis were promised how many years ago, right? You can update the software, and the car will go make money for you at night. I mean, this is a credible target that they're setting. I think when you're willing to put more manual content into assembly and less large automation tooling, your costs are going to be higher. So you're going to wrap some dollar bills around the first vehicles, which you do anyway. But you can start sooner and learn faster and get things out and get market excitement going. That's top priority for Tesla. They need to do that right now. I mean, if they could make some by the fourth quarter, they should do it. It would be the right thing for the company.
Craig, anything that you saw in that letter today that is changing your opinion? I believe you're at a neutral on the stock. Anything you heard today that would change things?
Yeah, I'm neutral with an $85 price target. I'm very bearish on the valuation, right? I think it should not be valued at a premium to Toyota. There's nothing they have that Toyota does not, right? People were looking for a potential adjustment around the Cybertruck outlook. Doesn't look like we have that. It might happen on the call. I think there have been more challenges there than anyone hoped for. This is still a very difficult year for Tesla. It is a big negative setup. You will see more margin pressure over the course of the year. 6-7% price cuts just this last weekend is a big deal. And doing a U-turn on India is not smart. They did that as well in 2019. They should have started then. If they'd have actually gone into India in 2019, the supply chain would be mature and their costs would be great. And they wouldn't be scrambling for an alternative to Shanghai. So, there are lots of issues for them to address at Tesla. Nothing fundamentally changes the way I'm looking at this. I think the consumer is not open arms for EVs right now. I think the EVs have got to come down in price, and they've got to be a compelling proposition for consumers. Cheaper cars, they get same miles, safer, better technology. That's the proposition that they're maturing into. But we've got more price cuts ahead to get there.
Hey, one last question. Sorry, Craig, because somebody just flagged me to an additional headline here that has to do with the cash flow at the company. Apparently, first quarter free cash flow was negative $2.5 billion. The consensus was looking for positive free cash flow of about $650 million. What's up there?
Yeah. So I'd have to go through that very carefully. But to me, the FactSet consensus for the quarter was 457,000 units immediately before the print, right? So the whisper number was 430, 420. So they pick your number. They missed by 35 to 70,000 units. That's a lot of money you got to spend, and the production was there for them to actually make that 457,000 original consensus forecast. So they themselves thought they were looking at a better quarter than what they posted. and it costs them some money. So they're going to have to bleed down inventory over the next couple quarters. Again, that's why they're putting price cuts in because the consumer is not as strong as they had projected.
Craig, really helpful stuff. Thank you so much. Appreciate it.
Thank you.
Well, still to come, we've got more earnings. We'll be talking about the latest numbers from Texas Instruments. Those shares also higher in the after-hour session. More market domination overtime coming up.
Let's get you up to speed on the action from today's trade, sponsored by Tasty Trade. We're looking at the Dow with gains of about 0.7%. The S&P 500 up about $1.20. That's 1.2%. The Nasdaq, the leader of the three, up 1.59%. And the Russell 2000 outshining them all, but just by a little bit, up 1.61%. Julie.
Let's talk about Texas Instruments, the company reporting first quarter numbers, beating top line estimates. Guidance for the second quarter also coming in better than expected, and the shares have been higher in after hours trading. Now, Texas Instruments, biggest maker of analog semiconductors, and has been undergoing something of a slump here. This might be a sign that things are improving to some extent. If you look at that forecast, it says sales in this current quarter are going to be $3.95 billion. Analysts had been looking for $3.78 billion. And the company, the midpoint of its earnings per share forecast, also leaving it perhaps a little bit of room to beat potentially here. And the company said revenue in the first quarter was down 16%. It fell to its lowest level since 2020, but that forecast, again, raising some hopes that a rebound could be coming.
Yeah, I'll tell you what, I'm looking at the long-term chart on the Wi-Fi Interactive. Year to date, this is sideways. Let's go to 2 years, because remember the AI hype, and this is not a Texas Instruments play, but I want to make the connection here that this is a stock that has traded sideways for several years. In fact, you got to go really far out. This is a 20-year look, and all you see is it's consolidating in a flag here. So, funny that. All right, Spotify shares jumping today on better than expected earnings ahead of the open. The company turning a profit thanks to a recent focus on efficiency. Joining us now is Andrew Merrick, Raymond James analyst. And Andrew, thank you for joining us here today. You reiterated your stance on the company, and I believe that is an outperform. And correct me if I'm wrong, your price target is $335. What's behind your call?
Yeah, correct. And thank you for having us on today. The first quarter results for Spotify, quite strong this morning. And what we're really seeing at the company for the first time that we can really recall is a double focus on not only growing users, not only growing the engagement of those users, but also profitability and margin benefits. This is a story that's kind of been stuck on the gross margin side for a couple of years, and now is actually gaining some significant leverage on the operating income side of things after some headcount reductions and a more company-wide focus on being cost conscious. So that's really a sea change in how investors are looking at the stock and how the numbers are flowing through the statements. So that's why we still remain positive on the stock. And this quarter was another data point in that favor.
It's so interesting that Spotify, the way you frame it, is just coming to this. I feel like, at least in tech land, like everybody got religion a couple of years ago in terms of cost and in terms of that focus on profitability. What took Spotify so long, and do you think that this will be sustainable?
So I think there's two things behind this. So yes, Spotify is very much a tech company, but it's also a media company, and it does not create its own content. It is dependent on content from other creators and other publishing and industry bodies who own the rights to that content. And I think that puts Spotify in a unique position relative to other companies in the tech industry. I think what we saw this quarter that gives us confidence that there's sustainability behind this gross margin trajectory, and not just kind of the one-off little adjustments that we've seen in the past, is that the reasoning behind the gross margin jump this quarter were things like cost efficiencies on streaming delivery, which was a result of greater revenue from their pricing increases. It's better focus on their marketplace products, which are data-enabled services that provide insights for labels and musicians. Those things are core parts of the business that can be utilized indefinitely. And so that's why we think that the margin outlook coming out of this quarter is better than we've seen it in the past.
Yeah, I happen to be one of the few Google Red Music, YouTube Red, users that exist. This is a service that is a competitor to Spotify. Where I'm trying to go with this, they recently raised my prices. I think they're just being competitive. They're kind of matching Spotify. Maybe they were waiting. But is the industry, these price hikes seem to be absorbed by the consumer. Is there room for further price hikes? I mean, we've seen this play out in streaming on TV, where people are starting to get a little cost conscious here because of all the options. Admittedly, streaming music a little bit different here, but I guess the bottom line, do these companies still have more pricing power in the market?
And maybe as a day one user of Spotify in the US, I might be the wrong person to ask in terms of the typical user dynamics. But what we would say is that digital music services, and Spotify specifically, have kind of industry low churn rates when it comes to digital media or digital entertainment. And as a result of that, we do think they have pricing power. When you compare it to streaming video, for instance, the content between streaming music services is going to be very similar. So once you sign up to a service, build your playlists, tune the algorithms to know what kind of music that you like, your switching costs tend to be relatively high, and so you just don't do it. And so as a result, you tend to lock yourself into a platform, and that leads to pricing power. And when we compare Spotify on an absolute basis in terms of dollars to Netflix or other forms of streaming or digital entertainment, it's still quite attractively priced.
And at the same time, if Spotify isn't going to make me pay more because I don't listen to audiobooks, that would be nice too, which I guess is part of the various tiered pricing. Andrew, thank you very much. Appreciate your time.
Thank you.
Time now for What to Watch. Wednesday, April 24th, starting off with earnings. Another big slate on tap for tomorrow. Meta, IBM, ServiceNow, they're all reporting after the close. Meta announcing first quarter earnings after the bell. Analysts expecting ad targeting from generative AI to be a focal point of tomorrow's earnings call.
And we're also getting earnings ahead of the open tomorrow from Boeing, Hilton, and Humana. Boeing facing its share of bad headlines this year, and analysts are expecting more bad news for the airplane maker as first quarter deliveries are expected to be affected by continuing inspections on multiple Boeing aircraft.
Ford also reporting tomorrow, the automaker announcing first quarter earnings after the bell. Amid the struggling EV market, analysts expect the company to meet first quarter EBIT expectations, but they see a declining operating margin in its EV business.
And finally, we're going to get some economic data tomorrow. Numbers for durable goods are coming out in the morning. Economists forecasting that the number to go up, giving us some more insight on the broader state of retail sales.
In other words, it's going to be a busy day. That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow for all of your coverage leading up to and after the closing bell. But stay tuned, we've got more Yahoo Finance on the other side.
New home sales rebounding in March, an encouraging sign for the real estate market. But for those still looking to place a new place to call home, there's a different option on the market to consider: the commercial to residential transformation. Now, for more on this, let's get to Yahoo Finance's Danny Romero, who is at a recently transformed office to residential space on Water Street in New York. Danny, you're in my stomping ground down there in the financial district. What's going on?
Jared, welcome to my crib. This is a one studio bedroom apartment on Water Street in the financial district. And the average rent here for this apartment is about $5,000. Now, this apartment building was an office space and has been converted to 588 apartment units. Again, the average rent is about $5,000. So there is some opportunity here. 38% of this building has been leased out so far. But again, this building comes with a plethora of amenities, including a hot tub, a bowling alley, a kids' room, and a gym, of course. Obviously, we got to work out a little bit. But look, New York City, bottom line, has an affordability problem. Data from the Department of Housing and Preservation and Development shows that renters have less than a 1% chance in finding an apartment that costs under $2,400 a month in this city. Now, the median rent right now is about $4,200. That's a 20% increase from pre-pandemic levels. In New York, though, if you want to buy a home and you're considering buying a home, the median income that you do need is about about $150,000. That's an annual income. And according to city data, 30% of households in New York City own their homes. Now, the income does range within those households. Bottom line, Mayor Eric Adams created a goal to build 500,000 new homes over the next decade, but there's been a series of complications. Obviously, a big debate among state lawmakers going on right now. But again, this is just one option that is here in the city. This is really helping the inventory front, Jared, so far. But again, such a nice crib right here. Yes. I mean, and the amenities, great.
At a price, though. Danny, thanks a lot. Appreciate it.
Yes.
Well, it's not just in New York City. Affordability remains a pain point for prospective homebuyers in many areas. High rates creating little opportunity for entry-level buyers such as millennials and Gen Z. The shifting housing landscape lending to a shift in trends among the different generations. Here to discuss as part of our week-long special, Real Estate, the New Reality, we have Dave Liniger, RE/MAX co-founder and author of The Perfect 10. Thanks for being here. Appreciate it, Dave.
Thank you.
So we just heard Danny talking about affordability here in New York City. Obviously, this is an issue in many areas around the country. What are you seeing from this Gen Z millennial cohort in terms of whether we are going to see the same level of home ownership that we once did?
Well, currently you're not going to see it. Housing affordability is a terrible challenge for everybody. Interest rates have gone up, and that means a bigger down payment or a higher monthly payment. And so with the limited amount of inventory we got, a tremendous demand for real estate prices keep going up.
You know, and I want to talk about some of the trends that you're noticing here with Gen Z in particular. They are shunning college in small numbers for trade school, and just maybe outline some of the benefits there and reasoning why they might be doing this and how it fits into your housing thesis.
Well, there's a couple factors. Number one, we don't have enough of the trades, and the trade income has skyrocketed. And so a lot of times the younger generation is taking a look. College, the cost, borrowing money and paying on it for 10 or 20 years for maybe a good income, when you can get a great income right now in the trades. I mean, there are welders that are making $100,000 a year within 2 or 3 years of trade school. So practically speaking, why go into debt if there are trade jobs that you want to do and you can make just as good of money?
So does that mean then that maybe the spending power of this generation will actually be a little bit stronger than some of the worst predictions are saying?
Yeah, I think the predictions are wrong. The millennials and the Y-Gen especially are much thriftier than any previous generation. I believe that comes from watching their parents struggle in 2007 and on. and all the foreclosures and the things that happened, I think has made them much more frugal about their money. And so their savings are doing much better than previous generations did.
Well, it's impressive. I want to switch gears a little bit, talk about the National Association of Realtors settlement and the impact that may have for anybody who's considering buying or selling a home now.
It's hard to tell what it will do. Part of the settlement is more transparency on the part of the realtor. Part of it is that if a realtor is a buyer agent and he's representing a buyer, he has to have an agreement in writing with a fee structure in writing that has been agreed to by both parties. Over the past decades, the seller paid most of the commission, split it between companies, and so the buyer agent was saying, basically, you're getting my service for free. Now the buyer agent, it does not necessarily have that, and the buyer agent's going to have to justify, what did I pay you for what you did?
I mean, even though the change is still, the exact impact is still sort of TBD with this. I mean, you just wrote a book called The Perfect 10. I imagine you've been reflecting a little bit on what you've seen over your career in the industry. How do you sort of situate this amongst the other big changes we've seen over the years in the housing market?
Well, I think the litigation explosion is certainly going to have an impact on the industry. Whether it's going to have a huge impact on the cost of buying and selling property, nobody knows for sure yet. The one thing it will do is it is going to start eliminating the massive numbers of low producers and part-timers in the industry.
Dave, we've got time for one more here. Anything you want to talk to us about? Give you the floor here.
Well, I think the thing is that interest rates will come back in line, but do bear in mind, over the 50 years of RE/MAX's history, the average interest rate, 7.78%. Exploded to 17% back in the early 80s. The last 15 years are unreal.
Oh, well.
What does back in line mean?
I think you're going to see 6% mortgages, the mortgage rate of the future.
All right. Well, we'll have to have you back and see if that comes to fruition here.
I hope
Appreciate you coming by here, Dave.
Thank you.
All right. Coming up, toy maker and entertainment giant Mattel reports its first quarter results. We'll have the numbers for you after this break.
Visa reporting its fiscal second quarter numbers. The credit card giant reporting better than expected results on the top and bottom lines. The shares up about 3% here. Credit card spending in the U.S. up 6.2%. Worldwide payments volume up 8%. Total processed transactions up 11%. People are still charging it on the card.
They are.
Yeah.
And in fact, payments volume at $3.17 trillion is up 7.4% year over year. To your point, Julie, from the estimate was for 3.2 trillion. So they actually didn't quite make it, but fairly close there. Payments volume at constant currency, you might have said that, up 8%. The estimate was right there. I don't see a lot of surprises here. I will chart the stock briefly on the Wi-Fi Interactive. First, here's a 2-year chart, and this pretty much goes back. Visa bottomed with the general market in October of 2022. You can see up about, 35-40% from the low. Net, it's up about 31%. And by the way, extended hours, it's up 3%. Yeah. Here's the longer term trend, and it's from the lower left to the upper right. That is a very steady looking chart. And also another interesting development was this was classified as a tech company, recently got classified as finance company, financial company, at least in the GICS system, which is a global industrial classification system. A little bit arcane, but it
determines what sectors various companies are in the S&P 500 and what their comps are.
So basically the tech multiple, they're saying, okay, no, Visa has a financial multiple, which is going to be a bit lower.
Yeah, MasterCard, by the way, I think is also catching a bid. I should mention Visa shares up a little more than 5% year to date, which has underperformed the market. So we'll see if this helps them catch up a little bit. Let's also talk about Mattel. It also reported its numbers, its first quarter coming in mixed here. And we're watching the shares here as well to see how they're reacting. They're up about 3% here. The quarterly loss at Mattel at 5 cents a share. That's excluding some items. Analysts have been looking for a loss of 12 cents. So that's better than estimated. First quarter revenue fell a little bit, less than 1%, to $809.5 million. That was short of estimate. So loss was better than estimated, but revenue was a little bit worse than estimated.
And you had a comment I think is quite relevant over the break, which is, with all the hype for Barbie, we're not seeing that necessarily reflected in the current quarter results, certainly not beating expectations. Here's Dolls, gross bookings, $294.5 million, but the estimate was for $306 million. That's about $10 million difference. Infant, toddler, and preschool gross billings, that was light at $135 million. Expectation was for $143. Vehicles beat. So 297 versus 285. Action figures, that was light as well. So just a number of metrics here.
Yeah, Hot Wheels. When you say vehicles, we're talking about Hot Wheels.
Oh, okay.
Hot Wheels, yes. And apparently there's a new animated series, Hot Wheels Let's Race.
It's one of the few toys. I have like 500 of those little cars. My mother... Wow. A lot of credit here, has saved them over the years.
Wow.
They take up some space, and maybe I'll break them out in a few decades.
So maybe they're coming back here, it sounds like. So they've got this, and Inan Kreis, who is the CEO of the company, said that helped the Hot Wheels sales, that series. He also said this year is all about profitability. He told Bloomberg that. So
learning a little bit about toys here.
Yes, we are. All right, coming up, the CEO of cannabis-infused beverage company Cann joins the show to talk about the brand's partnership with Barstool Sports. That's next on Yahoo Finance.
No more hangovers. That's what one company is promoting with its cannabis-infused beverages, one of the fastest growing sectors of the cannabis industry. And today we have one of the champions of the so-called Cali Sober lifestyle, co-founder and CEO of CAN, that's 2NCAN, Jake Bullock. Jake, thank you for joining us here today. Give us an overview. I understand you have a new partnership with Barstool Sports that's relatively new. Just tell us about your product and what you're doing with it.
Yeah, definitely. So we make a range of microdose infused THC and CBD products. They're really alcohol alternatives, so people are trying to drink less booze. They turn to our products and they give you a similar buzz. It's sort of the same strength as a glass of wine or a beer, but no hangover from alcohol the next day. And that's really starting to get into the mainstream. So you mentioned Barstool Sports, a partnership we just launched with them over the last week. And they're really coming to us saying, hey, we're excited about this category. We're seeing what—
And they came to you.
They came to us, and we've been doing this for a while. So we've been at it for 5 years. We've grown the business, and people really like the products. They like the taste of them. And so, we're trying to reach a broader set of customers. We started the company in Venice Beach in California, and that was great. And now we're trying to talk to people in Kentucky and Texas and Tennessee. And Barstool is an amazing platform to do that across their various media properties. And so we're partnering with them to really get the word out about CAN and the way that it can impact your life in a positive way.
So how does the partnership work? Do they invest in CAN? What are the terms of the partnership?
Yeah, so the biggest thing that we're doing is we're advertising on their platform. So if you think about Barstool Sports is this massive media conglomerate which has all of these really interesting media properties, predominantly their podcasts and their talent that are on those podcasts, and their social media accounts, and then they have social media accounts that even reach into various parts of people's lives. There's Barstool Duke, where I went to college, as an example. And so there's a lot of touch points to reach customers that we would otherwise not really get.
I guess what I'm trying to understand, how is it a partnership, quote unquote, different than you buying advertising with them, or like?
Yeah,
is that what it is, or?
That's predominantly what it is.
Okay.
But the thing that's unique about this is they've never done this before with a THC drink. So this is the first time that they're coming and saying, we're willing to take a bet on this category. We're willing to even allow this. And this is really hard in the industry.
How big is that leap there? Were there legal barriers before? Were there concerns about that? I mean, with the banking industry the way it was, with the SAFE Act hasn't been passed. What are some of the details there?
Yeah, so it's really, really hard to advertise cannabis products, as I'm sure you know. There's marketing restrictions. There's restrictions in all of the states in which we operate have very strict rules. Think about alcohol, but even more restrictive. And then you have some of the big digital advertising properties like Meta, Google, that in their terms of service, they restrict this type of advertising. So we have to be very careful. We built this brand on the back of a lot of celebrity investors that had big megaphones, people like Gwyneth Paltrow, Kate Hudson, doing ads for us, talking to their followings about it. Barstool's a similar approach. It's finding those big megaphones, places where they will actually take the risk and say, oh yeah, we will work with a THC brand, a THC drink nonetheless, to get the word out.
It's a growing category, and the sort of alcohol alternative category more broadly is growing a lot. How do you stay competitive when there are more other choices that are popping up?
It's really challenging. I mean, we started in dispensaries where we were competing against other cannabis products. That was, it felt really hard at the time, but that was a small box. Now we're in Total Wine and Spirits, which is one of the biggest alcohol retailers in the country, and we're competing for shelf share against some of the biggest alcohol brands, not just non-alcohol.
And are you guys only sold in states where it's recreationally legal, or can it be sold nationally now?
Yeah, so we're available for sale online in a number of states, about 30. We're also available in some states in liquor stores, about 10 states. And then we do sell in dispensaries with recreational programs, about 4 or 5.
We got just a minute to go. What about some of the naysayers saying, well, this promotes not true abstinence because you have alcohol, you have the effects of alcohol, but then you also have the potentially addictive properties of cannabis. What do you say to that?
Yeah, look, this is not vitamins, right? It's another product which if you drink a lot of it, you're gonna feel the effects, and they're intoxicating effects. One of these is probably not, but a few of them would be. And so this is not swapping out your alcohol for nothing. But it is, we think, a healthy choice to make, to drink a little bit less booze and to drink these instead. And the science really does back that up in a lot of ways. We're learning more about it. A lot of the work that's been done in the past is about smoking. This is a product that doesn't require you to smoke, it doesn't require you to vape, and those are also potentially negative health impacts. And so that, along with the fact that it's only 2 milligrams, our high boys have 5 milligrams, it's really, really low potency, and you have to drink the whole thing to get the full dose. So there's a lot of things working in our favor to keep people from over consuming or for having a bad experience.
Jake, real quick, what's the long-term plan? IPO, to sell yourselves to a bigger company? What are you planning?
Yeah, we are seeing incredible consumer demand for these products, and so we're heads down growing the business. We don't know how big it can be. We just launched in places like Texas and Florida, and so those are really big markets, and we're going to learn and evaluate along the way.
All right, Jake, thanks for being here. Appreciate it.
Thank you.
And that'll do it for today's Yahoo Finance Live. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.